Hey, Rob.
Who wore a suit today? Look at me. Look at you.
Oh, mate. No, what can I say? You should have told me to dress appropriately for the occasion, mate.
Mate, haven't you watched any of the podcasts? This is how I roll.
No, you do roll to your own beat, mate. That's what I love about you, actually. You're your own man, that's for sure. I mean, it's a great part of town, as you know. It's hilly and leafy, and
Yeah, it's nice.
I remember you talking about your kids. You went on the train up there. Was it the Eltham?
Did we? Yeah, we go there. We go there whenever we can. The Diamond Valley trains.
That's it. Yeah.
They're cool. I probably enjoy them more than my kids do. Mate, if I could have a beer on that train and just relax, man, like that would be sick.
Oh my God!
Don't you reckon?
You are. I tell you what, you got different thinking, mate. You're an outlier, mate. Of all things you think of, a beer on the back of a little miniature train.
That'd be fun. That'd be fun. All right, we'll get started.
I was going fishing for a compliment myself. I've got nowhere. Anyway, keep going.
Mate, I'm trying to start the podcast.
I'm sure you can edit all this anyway, so I'm not. No, but I know. Just make it official or sound official.
All right, we got to compose ourselves, man. All right. All right. Hello and welcome, everyone. I'm Robert Baharian, and this is Masters in Investing. On this show, I talk to guests about financial markets, the economy, investing, and business. Don't forget to subscribe and leave us an awesome review. Let's get into it. My guest today and good friend is Koby Jones of the SILC Group, a specialised lending group focusing on alternative assets. In our conversation today, we talk about the rise of alternatives. We discuss the role alternatives play in portfolios and what investors can expect from alternatives in the future. Hope you enjoy my conversation. Let's get into it. Koby Jones, welcome to Masters in Investing.
Thank you, Robert.
Haven't had you on this before, so it's good to have you on. Hey, mate, let's get straight into it. SILC Group, what's your role at the SILC Group?
Well, firstly, thanks for the opportunity, Rob. But I've known you for a number of years, and it's a bit funny actually talking.
Who's hosting this podcast, mate? You or me?
Well, the way you're going, I'll have to jump in. But look, yeah, we've known each other for a number of years, and I've really enjoyed our sort of relationship. Actually, just sharing different perspectives on the world. But as you know, yeah, look, I'm the managing director and founder of the SILC Group. We're a specialist financial services provider focusing on wholesale clients. So those wholesale clients are high net worth, family offices, commercial and corporate clients, as well as to a lesser extent institutional clients. We provide three main services, and that's around what we term as the portfolio solutions. So they're things like trusteeship, fund administration, licensing, custody, and registry. And that means that we're creating a lot of managed investment schemes or managed funds.
So people come to you, Koby, and they say, I need help with this fund that I'm running or wanting to run. And you help with trusteeship, custody, registry. So you handle investors and communication and all of that stuff.
Yeah, spot on. So we undertake the KYC of the investors. We undertake the reporting to the investment managers. We make sure that the investments that the investment manager is investing in is complying in accordance with the trust deed and the disclosure documents, etc. So yeah, we really formed that business a number of years ago, and I'll give you the backstory actually, but I'll go through this. But then we provide what we term as the capital solutions, which is really providing capital and undertaking capital raising for the various funds that we act as trustee for, and also support the transactional activities. So as you're aware, given that we focus on alternative assets, there's a number of opportunities for us to support our fund managers from an acquisition perspective, but also a divestment perspective. And then we're undertaking some technology development through our digital solutions business. And that's really creating a digital marketplace for the funds and the trusts that we are trustee for to list onto our platform. And then within that platform, we'll have a digital exchange, which creates a secondary market, i.e. liquidity in those assets.
Who can participate in that?
As you know, though, liquidity.
Koby.
Our focus is purely wholesale clients. So
No, but I mean, who can participate in that exchange? So is it anyone and everyone that can jump on and become a member of this exchange? How does that work?
Yeah, because it's for wholesale clients only, it'll only be allowed for wholesale investors. But the assets themselves, so the asset sponsors, if they're purely a single asset or a fund manager, we can list their trusts onto our platform. So our aspirations are global. So we want to create a global marketplace of wholesale investors. But that's the type of audience that we're really sort of focusing on. We want to specialize in that area. As you know, and as we just discussed before, the retail landscape is very difficult from a compliance and regulatory perspective. So it limits a lot of our ability as a product manufacturer to be able to engage with retail investors, not just domestically, but globally. So it just means that our area of focus and our specialization is on those wholesale investors. Sorry, mate.
No, so those funds that you talk about, so the ones that you administer and the ones that you look after and help establish, and the ones that are on your exchange that you're building out, what are these investments? Can you just give us a bit of an idea and flavor for those who don't know who the SILC Group are, or what types of investments that you're dealing with? What types of investments are they?
Yeah, and thanks for the question too. And if I take a step back, if I look at my background in financial services, I've worked at 3 of the 4 major banks, and then I worked for a boutique investment group called Wilson HTM. But when I worked at the big banks and even Wilson HTM, I primarily focused in alternative investments and alternative assets, as well as structured product. My main areas of focus when I was at those institutions were in global financial markets and private wealth management. And my area of focus was primarily on wholesale clients. And what I've sort of discovered through that process is wholesale clients have a heavy, not bias, but a heavy interaction and engagement with alternative assets. And alternative assets are primarily unlisted or non-traditional type investments. So if you look at traditional investments, they're listed equities, government bonds, and maybe even property and cash. But there's a whole bunch of investment opportunities outside that sort of little ecosystem. And I say little because if you look at, private equity, if you look at private debt, if you look at property, even synthetic assets like, let's call it derivatives, and even more exotic assets, you could say things like intellectual property rights, or even fractionalized ownership and, artwork or classic cars and those sorts of things. Those actual asset classes are emerging and becoming mainstream, in the investment ecosystem. So, and I'll just say that because historically they've been very difficult to access, but now with organizations like ours, where we create those trust structures, it gives people the opportunity to access them on a fractionalized basis. So you're unitizing, those assets through a trust structure. People are able to access them. The real main difficulty, I think, in alternative assets historically has been liquidity or lack thereof. And so what we're doing is investing into a digital exchange which creates liquidity in those assets. And again, all via trust structures. So it's not directly via, shares, but all via trust structures. And that means that you can work at all parts of the capital structure. You can work in any sort of geography and right across any sort of asset class. So that's, alternative assets are non-traditional and primarily private market type investments.
You said before, Koby, in your dealings, you found that most of your wholesale clients, whether they're family offices or business owners or whoever, typically they're spending most of their time looking at alternative assets. Why do you think that's the case? Why do you think that particular segment of the market is more focused on those areas rather than the traditional asset classes that you spoke about before?
I think, look, the benefits that wholesale investors have is that they can be very much asset rich. They may be income rich, but they're also asset rich, and that means also they've got a longer duration, in their portfolio. So it means that they can take positions where it's in an illiquid environment. So that's one element to it. The other thing is they've got a huge exposure as it is to listed assets. So they're looking for other opportunities to diversify. And it's in alternative assets that give the alpha or the outperformance across their traditional sort of investment portfolio. So because they've got longer duration in their portfolios, they're looking for outperformance. They're generally getting that through alternative assets. So I saw that, throughout my career when I was in banking in particular, and you see these family offices and high net worth and business owners, they've got a huge exposure to businesses. Again, they have those liquid assets, but around those sort of core portfolio of assets, they've got alternatives. And again, alternatives can take various shapes. So they can.
Yeah, alternatives just don't fit in the bucket of stocks and bonds and cash.
That's it.
Or real estate. So the four different buckets. And if something doesn't fit in there, it's deemed this mysterious alternative investment that is high risk and managed by a bunch of charlatans, right? Like that's the perception. Am I wrong?
Correct. No, you're spot on, Rob. And it's a funny, I won't say misnomer, but it actually trickles down from a number of areas, from the research houses to the insurance providers to the licensors.
Tell me about that. Talk to us about that.
Well, I just know when I first started, my business, and I talked to them about alternatives. I mean, the insurance providers, you just times it by 5 for the premium because they saw it as more risky. Or riskier.
Because they don't understand it.
Correct. I mean, I think, when you're dealing with traditional licensors and financial planning groups, et cetera, they're ticking boxes, as to the product that can be, put onto an APL. And they're predominantly listed assets, and they like the liquidity or the liquid nature in those traditional asset classes. So that from their perspective is a de-risked type, investment. But yeah, I mean, I remember talking to them about, an FX fund, a foreign currency fund. Now, FX is the most highly traded, asset class in the world. And yet in their minds, because it's non-traditional, i.e. non-equities and not bonds, it's high risks. So therefore you're in the high risk bucket and your premiums go up. So, and then you get the research houses. So I think they're very, very conscious of, having liquidity in portfolios. And so therefore, private equity or venture capital or private credit, and property related type funds just don't fit into that sort of, traditional type bucket. And so therefore they're deemed as alternative and therefore more risky. So yeah, I'm in that space because I've seen the opportunities that alternatives bring and the wealth that it can generate, to investors. And, there's some learnings there with high net worth and, as I said, family offices and business owners being exposed to that asset class and being wealthy.
Mate, what are the key or most common funds that you guys are dealing with? Are they property related? Are they cryptocurrency related? Like what are the, and I'm sure there's many of them, but can you sort of just pick out a couple that you find that you guys are dealing with more often than others?
Yeah, again, another good question. It's primarily 3, let's call them asset classes or sectors that alternatives are really becoming mainstream and the norm. And that's mainly in private equity. People are familiar with private equity. Again, historically been very difficult for individual investors to access. But we're creating these trust structures or funds so that people can take ownership in private companies on a portfolio basis. The other one is private credit. So again, historically, the banks in Australia have dominated the lending landscape, particularly in commercial real estate. But more and more commercial real estate credit funds have emerged. So you've got the likes of Qualitas and Wingate and CVS Lane and MaxCap. Those sorts of guys have done fantastically well, in providing just very focused credit into real estate on a commercial basis. But now, more and more funds have emerged in that area, and we're certainly a trustee of a number of those. And then the other one is the property equity fund. So people are taking positions in property equity developments where they're taking fairly short-term duration risk for development or property developments, and again doing it on a sort of quasi syndicated basis with multitude of investors.
And so
then the three.
Go on.
Sorry, Rob. No, I was going to say, but there's other asset classes that we're acting as trustee, whether it be in infrastructure.
Sure.
We've got one in hotels. We've got we used to have an energy fund. We've even got a fractionalized ownership in classic cars and prestigious cars. An FX fund, and you mentioned cryptos.
Is it Chrome Temple?
Correct, Chrome Temple. Yeah. So it's pretty cool, actually.
That's really cool.
Yeah, I mean, it's not to say you as a unit holder can drive these cars. They're actually an asset, and they're
no. It's like saying I own shares in NAB. You can't go and use the building. Like
that's it. Spot on. Yeah, it's good. Correct. Or artwork, right? So you can fractionalize ownership in artwork. It doesn't mean you can just go and take it and hang it on your wall at home.
Yeah.
But yeah, they're the three: property and credit, as well as private equity.
So, are you finding that there's just, because one of the things that we're seeing and everyone's seeing across the world is just so much money and so much liquidity, but such a shortage of assets to be buying. So, you talk to people who've got enough money in equities, who've got enough money in residential property, who earn good money, who don't need to hold lots of cash, or they don't need to hold bonds. And I guess that might be the typical high net worth, ultra high net worth client that you might be describing, where they've sold a business or they're running a business, they've got ample liquidity in, I don't know, their stock portfolio, and they're basically capped at, well, when I say capped out, they've got enough of those different asset classes, right? And so, I mean, how much more Aussie stocks do you own, right? I mean, presumably there gets to a point where you need to start looking at alternative assets. And then you start looking at things like whether it's artwork or cryptocurrency or whatever it is. Mate, do you think that there's a problem here to the extent that there's just too much money slushing around the system with interest rates being at zero, and people are just chasing and just bidding prices up? Yeah.
Again, really good observations, man, and I think that's what's driven the multiples, in our stock market in particular, because the cash rate's the lowest it's been in history, right? So it's never been at these levels. So it just means that to borrow money and invest that money is a pretty cheap exercise. And what that's done, I think, is inflated a lot of the listed stocks. But off the back of that, people are going, okay, where else do I look at deploying my capital? So alternatives is definitely a beneficiary of that. There are instances where you hear of people borrowing cheap money to go and lend it out at more expensive money. And the gap there too, as an example in credit, is that the traditional banking channels have really left a vacuum in that sort of middle market where developers are looking for capital to undertake a development. The banks won't fund it. So
why won't they fund it, Koby? Because so many people ask, well, if the banks aren't touching it, why should I touch it? Is it a banking issue? Is it a regulatory issue? Like what? Or is it a combination of both? What is it?
Yeah, it's a combination of both. I mean, arguably, I think there's been a really good structural shift, post the Banking Royal Commission, and it's meant that APRA's, had some, greater input into the capital controls and the capital requirements and their limits on the banks in terms of where they can and can't lend to. And I think historically developers had it pretty good in terms of the cost of funds. But arguably, as a bank, a AA minus institution shouldn't have been lending at those rates, for that, type of risk. So the LVRs have certainly come in. Their pre-sale requirements have certainly gone up. Their risk appetite, has decreased. If you look at a bank's perspective, it's at a portfolio basis. So you can't have too much exposure just to property. So, if, for example, APRA says, and I'm being hypothetical.
They're a bank though. What exposure are they going to have?
Well, that's the thing. They've got to look at other means of deploying capital, and that's where you can see there's a lot more lending to retail, and there's probably more lending to institutional, right? So, but in the mid market, where the development risk is, the banks don't have as much appetite as they used to. So it's not to say that the tap's turned off. It's just it's not as strong as what it used to be. in terms of the appetite from the banks. So, it just means that second-tier lenders or non-bank financiers are able to come in to provide that capital. And where does that capital come from? Investors. So investors are saying, hey, I want 5, 7, 10% of my money if it's a first mortgage. And they can actually get that because the borrower is willing to pay for that so that they can actually undertake the development. And again, the developer, can't unlock their development profit without that, that credit.
You need the money to make the thing real, right? And so what are we eating into? Is the developer eating into their margin? So instead of being able to borrow from the bank at 5, they're having to pay 10 somewhere else or whatever the number. I'm just making those numbers up. I mean, ultimately, it's the end purchase that pays, right? Unless prices can't get bid up any higher, then the developer eats into their own margin. But presumably, there's enough fat in there that they can absorb that, right?
Yeah, and look,
in good circumstances, not always.
Yeah.
And then those people don't get the money lent to them. Right.
That's it. I mean, and look, you still have to be prudent when you're lending that money. So it's not like you've got a loan to value ratio of 90% or something like that, on a first mortgage. You still have to be prudent, and you still have to have, your pre-sale requirements. Is it in location? Is the project itself being de-risked? Does it have permits? Et cetera, et cetera. So it's not like you're just going out, willy-nilly, funding these developers because they're asking for it. You still have to undertake the credit assessment, on these particular developers and the projects that they're undertaking, because we've seen, not too long ago, the likes of Stellar Property Group, et cetera, blowing up. They were overpaying for sites. Their cost of funds was way over, and they had a liquidity issue. So it's not like it's just everything just goes up, as everyone sort of thinks in property. It's not the case. But if developers have got enough margin in it, and that's one of the considerations that a funded, is how much development profit there is, is one way of ensuring that you're sort of de-risking. That's where it really works coming in. So I think gone are the days of developers making 50% plus on everything they touched. It's obviously, it's sort of come in since then.
Can I title the name of this podcast, Everything Just Goes Up?
Yeah. If only that was true. But having said that, Rob, like we're very lucky to be living in Australia, mate. So I believe, yes, COVID's been a very difficult thing for us all, but post-COVID, and even during COVID, Australia's done very, very well from a global perspective. And once the borders do open up, we will still see more migration, I think, come into Australia.
Well, New South Wales are already accepting overseas. I mean, I think that's the first sign of government. Governments realise it, right? But I think we have to realise that can't turn. That's not going to stop. No. It's just a fundamental backbone of our country and our economy and our potential, right? So there will be that will be worked out as to how that can be accommodated, right? Yeah. Mate, before you were talking about licensees and advisory groups, can we talk about that a little bit? Because certainly in conversations that I have in my circles, that those that operate under the sort of wholesale banner, like I said, running shady operations in their basement or from the back garage. Like,
they're good generalizations.
Totally right. What is it that the retail investor is missing in all of this? What are they missing out on, if anything at all?
Yeah, look, don't get me wrong. Not necessarily all wholesale products are should be accessible to retail clients. But wholesale products give huge amount of opportunity for investors to make returns commensurate with the risk. They get those returns. And again, if I'm dealing with high net worth family offices and business owners, they have a huge portion of capital into, let's call them alternative assets, right? So non-traditional assets. And sadly, it just means because they are wholesale product, the retail investors don't get an opportunity to access them. Now, not all products should be sold to retail
absolutely.
Investors,
Yep.
right?
Yep.
So let's just
clear that up.
Front. Correct. But there are some brilliant products that are out there, some opportunities that are out there that retail investors actually miss out on for their savings, for their retirement, for their lifestyle. And I think, there has to be some way of being able to provide those opportunities to retail investors, to some extent. I'm not saying that sort of broadly. So again, let's keep that clear. But sadly, retail investors, because of the regulatory environment, because of the regime that we're all operating under, they're very limited in what they can and can't access. It's very much off the shelf. And the reality is too, because of compliance costs within the retail space, it just means margins or costs actually eat into returns, for those retail investors.
Meaning, if I'm running a wholesale fund and an investment, if I want to then bring that to the retail market and en masse, the regulatory environment is prohibitive. Is that what you were saying?
Yeah, it just creates. It does. It's.
Well, it can't be that prohibitive if there are that many retail products on the market with good businesses being raising millions, if not billions of dollars. Can't be that prohibitive if you can get on the masses with you.
Yeah, but look at the type of product, that are being offered, and they're primarily listed, and it is very much a volume game. So alternative assets, they are a higher touch, type environment where, you need.
What do you mean they're higher touch?
Well, you've got to undertake due diligence on assets. You've got to, make sure you got the right processes.
But you still have to do all those things if you're running a retail fund. In fact, you're probably under more scrutiny, if anything.
You are. But if you think about your universe of investments and the sheer volume of them, if you're investing in BHP and Telstra and, the ANZ and NAB, in terms of their listed stocks, if you're putting in $10 or $100 million, it's probably not too different in terms of your due diligence, right? Because you're accessing publicly available information. Whereas in private markets, you're under the bonnet, you're asking questions, you're taking a very different sort of level of DD, and the ticket sizes are generally not as large. So I think compliance costs, at one end, are more expensive at retail, but also the operating costs, in an alternative asset investment can be expensive as well.
Do you think that with all the money chasing down yield and returns and whatnot, and with there's more and more talk of rates rising. Obviously, globally, New Zealand raised rates last week. If you talk about being close to home, like if we are in this realm of rising rates, and if you think about duration as they relate to assets, so stocks having long duration, so not the sort of the typical duration that people think about when they think about bonds and bond duration, but real estate development. If we're now moving into this era of rate rises now, which I don't know, we've been talking about it for the last 10 or 15 years, so maybe this time it comes true, but it certainly does feel that way with inflation and employment numbers and so forth. Like, are we getting towards a tail end of this cycle where people are just more concerned about the return and not the risk? Am I making sense? Like, where people...
Sorry, Rob. Yeah, it's been risk on because cost of funds. It's been risk on for some time.
Yeah. So is that an issue now for if we talk about alternatives and if we talk about duration on classic cars? Like, you can't just sell a classic car like that. Maybe you can. I don't know. I could be totally wrong. Yeah. But I presume the duration of a classic car or an IT company is way longer, right? And so if you've got a rising interest rate environment, presumably that's not good for those assets.
In some asset classes, you're correct. Yeah. But if you look at it on a portfolio basis and you've got, 10,000 cars in that portfolio, then you're sort of mitigating some of that duration risk, right? So it really depends on the type of asset class as to the effect of duration within a portfolio. And some, as alternative asset classes, they're almost uncorrelated to traditional, assets. One example I'm thinking of right now is what we call a life settlements fund, and that life settlements fund actually takes positions in life policies. And basically, what they're doing is investing in mortality. On mortality rates. So it's got nothing to do with, interest rates, yield curves, FX, rates, equity markets, etc. These asset classes are completely uncorrelated to those traditional asset classes. So if, for example, again, taking another alternative asset class as being credit, I'm lending money at 10%, regardless of what the yield curve is doing or short-term, money market is doing. I'm getting an interest rate of X% on a either quarterly or semi-annual or annualized basis, even capitalized basis. So, that's on an individual, asset level.
Sure.
And then at a portfolio level, where you've got a multitude of these different, assets within that portfolio, and they will settle at different terms. And the reality is too, Rob, if, for example, interest rates start ticking up, that will be reflected in the cash flows of those portfolios. If anything, it would have a positive effect. So it really depends on the asset class, and not just the single asset that people are investing in, but also at a portfolio level.
I've mentioned this to a few people now. I don't know how many people have actually seen it. I was talking to Richard Quinn of Bentham Asset Management last week, and we were talking about the composition of investor portfolios, what they used to look like, 20 years ago, what they look like now. And in order to get, this is a reflection of the interest rate environment, but they were talking about, so don't talk about interest rates, but they were talking about the composition of one's portfolio in order to get an expected return with a certain amount of risk. And basically all that was in that portfolio was stocks and bonds. Fast forward 20 years, 25 years. Now the composition of one's portfolio needs to look like stocks, real estate, VC, private credit, crypto, whatever it is, right? And it's just this. It's a mixed bag of investments. And so the average weighted returns is the same as what you used to get back then, and so too is the risk is there as well. So it's managed accordingly. But the point that the article was trying to make was that 20 years ago, you needed only these two things to give you the return. Now you need these 6 things to give you that return. Now, yes, I totally understand that it is an interest rate issue, and what interest rates were back in the mid-90s is very different to what they are today. But I also think, and I just want to get your take on it, is what used to be available to investors 20, 25 years ago is not what is available now. Back then, the things that you and I are talking about today, or you're talking about today, one, probably never even existed. Two, if they existed, they probably were existing only for large institutions and pension funds and so forth, and significant families and so forth. And here we are now. You're talking about buying fractionalized shares in cars or artwork and things like that. So I think we're in this completely different world. I want to get your take on that, but also want you to comment on, if you can, on the risk appetite of people today, maybe versus back then.
Look, there's a number of elements to that. Okay, so you're exactly right.
100%.
I think, 25 years ago, access to certain type of investments very different today. Interest rates, very different today. And I think also there's been a level of either upskilling and knowledge within the community. Sadly, I think just generally though, Australia lags behind in alternative assets in particular versus some other jurisdictions. Whether it be out of the US or Asia, UK, Europe, they're far more advanced than what we are down here.
I'm just noting that because I want to talk about that in a second. I'll let you finish this part.
By all means. But I think it's the sum of all those parts that you've just highlighted as to why investors are now turning to alternatives. And I think, look, at this given point in time where interest rates are, and where the listed markets are, and particularly the ASX, there's probably more downside risk than anything. So people are looking to pivot. And don't forget too, Rob, it took a good 10 years for the ASX to recover post the GFC. So it took a long time for it to get back to the same levels as what it was post GFC. So there's a lot of lost wealth in that period of time, and so people, it's forced them. It's really driven the need for people to look at alternatives versus traditional asset classes. But interestingly, that's always been the mindset of business owners and high net worth and family offices who have always, invested in alternatives. Now, owning something 100%, in a company is an alternative type investment. Owning 100% of a development is an alternative. Now, though, when you've got organizations like ours where we're fractionalizing and unitizing, these assets, it's giving people more access and choice, into those alternative asset classes, which again, historically had, huge barriers to entry. So we're, opening the market up further and further. But unfortunately, as you know, those structures aren't available to retail. So it's not like, mums and dads, can actually invest in these alternative asset classes. And again, I'm not saying anything's, I don't think it's one size fits all. Okay, so there is a need for liquidity, et cetera, and some of the retail clients don't necessarily have that sort of duration, or that there is a need for them to have liquidity. So again, it doesn't necessarily suit all those type of clients, but certainly wholesale clients where they're asset rich and they've got income to support their lifestyle expenses. They can actually take a different view from a portfolio perspective versus, say, a retail client. But again, organizations like ours are creating these trust structures to give people that that access to those type of investment opportunities.
15 years ago, we say 15 years ago sounds like a long time, but it is more or less in and around the GFC, right?
Yeah.
Even to this day, there are still people and investors making a shift from what they've been used to for decades and decades, from their Australian direct share portfolio of 23 different stocks, and that's their portfolio, to being able to move into managed investments, to go from managed investments from onshore to potentially even offshore, to then go from managed investments to exchange traded funds, and then being able to trade securities in Israel at the click of a button. We couldn't do that. 10 or 15 years ago. Maybe we could have. I might be exaggerating, but hopefully you get the point. The point is that technology and the way investment markets and providers are evolving are allowing investors to have access to these. And kind of what I'm hearing from you and what I feel is that once we go through the universe of bonds and stocks and get that out of the way, then we start sort of, sticking our neck out and going, what's this thing called alternatives? This has been going on for years and years and years, but it's just that it hasn't been available to the majority of people. And now all of a sudden it's becoming available to more people, but only a certain group of people. And maybe in 5 or 6 or 7 years' time becomes available to a further subset of people and a further subset of people. And it becomes a normal component of people's portfolios. But you said before that Australia lags, was it exposure to alternatives compared to global peers? Is that what you were saying? Can you just explain that? Like, what can you shed light on that? Because I'm curious to know some numbers if you've got any.
Yeah, I mean, I won't. You don't quote me on any of these numbers, but I know historically, it's been the old 60-40, in Australia, with 60%, stocks and 40% bonds or cash, maybe a bit of property. So, and really no exposure or very little exposure to alternatives, and that's not just retail clients, by the way. It's also, inclusive of wholesale clients. And this is something, probably 5-10 years ago, very, very underrepresented and very underweight, in alternatives. And I do think it's sort of picked up, particularly with those three main areas that I mentioned before, being private equity, private credit, and also property or unlisted property. So exposures have certainly gone, in that direction. But if you look at big industry funds and, pension funds, et cetera, they're still underweight, alternatives. But again,
underweight,
it's players
relative
like
to what?
Well, it can offshore peers. It can also
Right.
be, I think of instances like the Future Fund. I mean, the Future Fund has performed extremely well, and they've got a heavy bias to alternatives. In fact, if you conclude, they've got an alternatives bucket, but if you include also property, as in direct property, as well as private equity, and I think infrastructure, it makes up like 2/3 of their portfolio, which is
Wow.
absolutely huge.
It's a big
Something
number, isn't it?
along that. It's still a bit, yeah. But it's more than 50%, let's say. Okay, and they're outperforming from a volatility and a returns perspective, again compared to their peers. But again, I think there's some regulatory overlays. But it was a good point you made around technology. So I think regulation is certainly having an impact where it reduces barriers to entry for market segments. Technology is making things far more efficient. We're becoming a bit more borderless in terms of how we can and can't invest. And I think the notion of, there's a lot of talk recently around peer-to-peer type, investing, and that's really emerged. But again, you want some regulatory overlay and compliance to be able to protect investors. So it's not like, you can just do anything. Again, because you're in wholesale doesn't mean, okay, great, you can
Sure.
just disclaim yourself away, and you can everyone else takes on the risk. I think from a reputational and insurance and a longevity perspective, you don't want to be undertaking any sort of activities that can compromise the integrity of your transactions and the product that you're working with. But there's a lot of inputs into bringing these opportunities to market, and therefore increasing exposure to alternative assets. I do believe, over time, alternative assets will make up a much bigger representation in investors' portfolios, but not necessarily retail. I don't think that will necessarily happen, in the short term, but certainly in the long term, there will be things that I think product that will sort of suit the retail investor over time.
When it comes to advisors, wealth management firms, and alike, do they need to start thinking about how they manage their businesses and client books and whatnot ultimately? Because I almost feel like are we as advisory firms doing our clients to some extent a bit of a disjustice to the extent that we're not talking to them about other options and alternatives for the right ones, mind you? Let's just be crystal clear about this. Are we looking out for their best interest, or are we making sure that we don't get, crucified for doing the wrong thing?
Rob, if you just go back to the question of what is a financial advisor meant to do? Is it protecting wealth? Is it generating wealth? Is it, meeting someone's goals and objectives? Is it all that, or a combination of all those things, right?
Probably a combination of all those things, I'd say.
Correct. Now, arguably, can you just do that through certain products and asset classes? Probably not. I mean, the reality is too, most...
you might be, but you may not be doing the best. It may not be the best way of doing it.
No, I would argue too that if you look at the global universe of investments, and you look at where most financial advisors clients' portfolios reside, it's primarily in Australian listed assets, and of those listed assets, there's 2,500, 3,000 stocks. It may be primarily in the top 50 stocks. Now, if you look at the Australian stock market, what does it make up, globally? It's probably less than 2%.
It's 2%.
And you're investing in 50 stocks. Wow. And that's just listed, right? So you're missing out on a whole bunch of, other asset classes, whether it be real assets, being real estate, infrastructure, even public assets, directly, private assets, being private equity, private debt. And again, synthetic assets or even more exotic assets
Mate, who's going to keep up with that when people can't even keep up with the 6,500 Australian share funds that we have, right?
Very good question. There's limitations around resourcing and bandwidth, right? So it's not as simple as say, okay, great, I'll press a button and I get access to 55,000 stocks or whatever it might be. That's a very valid point, right? But there has to be some level of either due diligence and oversight and governance, into the underlying assets, because it's just not like you're going to throw darts, at a dartboard and hope for the best. You really want to make sure that you're accessing quality investments, right? So you as a financial advisor, it's very difficult to do that analysis. So you want to have some, capability of outsourcing some of that research. But the research houses themselves should also be looking at, other alternative investment asset classes, because that actually provides benefit, to the investors. But it's not as just simple as just saying, okay, I press a button and, away you go. I mean, and I think too, and again, it's naturally as a business owner, you do things that make your life a little bit easier and more efficient. And so therefore, if you're operating with a platform or via an APL or whatever, you've got to naturally select those product,
but whose interests are we serving there? Are we trying to streamline our business efficiency, which, one would argue
nothing's wrong with that.
No, there's nothing wrong, because otherwise, if you don't have a streamlined, clean running business, how can you expect to look after your clients when you can't even look after your own backyard, right? So yes, you're absolutely right. But I suspect a lot of what you're talking about has to do with the way we always used to do things, the way advisory firms were set up to then be run by licensees. And so we've gone from, the big institutions to then licensee groups. And look, don't get me wrong. I think licensee groups are great if that's what you want and need, and it serves your purpose. But I suspect a lot of them would be still trying to manage their own risks, right? I mean, we're all trying to manage risks here, and at the same time balance actually doing what we're actually there to do. I just wonder what it is that we're not looking at for clients. That's all.
I think, look, technology will play a role in that, though, Rob, to create some efficiency in that and scalability. So there's a lot of due diligence, in an asset or a product or a project, whatever it might be, a sponsor, before it's, being offered. And then there's ongoing, disclosure requirements, on those particular assets or asset sponsors. So, it's not that simple. It's not as simple as just saying, because of tech or because of regulation, whatever, we can press a button and we get access to a multitude of investment opportunities. It's not that simple. And I think, you're well aware that certain, and private credit is a good example. When you lend money to a particular project or asset, it's got a finite duration. So it may only last for 12 months or 18 months or 6 months. And then it's finished, it's just extinguished. And then, as an investor, I receive my, principal plus my coupon or interest. And then I've got to look at reinvesting that. So I'm not, again, a lot of due diligence up front, on those particular assets before they're offered to investors. So you've still got to have internal efficiencies, and again, technology will provide that, and capability and resourcing, etc. But from a financial planner's business perspective, you've got a combination of what your operational requirements are and the outcomes that you're providing, your clients are. You've got to sort of balance that.
In your conversations with investors, let's say, you talk about before the volatility in markets. Last year was a really, really good example of something coming out of nowhere and derailing everything, right? And that's always a risk. And over the last few years, we've seen technology really accelerate. We've seen this whole conversation we're having today really push forward, and people be able to access a whole bunch of products, and whether it's fractionalized or just done in very different ways. Do you have any insight into whether or not people are cutting their exposure to more traditional asset classes and redeploying them into alternatives? Do you have any insight into that?
Yeah, not the clients I'm dealing with. It's pretty much been business as usual that I've seen. If anything, they've acted more opportunistically to, get more exposure, per se.
What do you mean acting more opportunistically? What does that mean?
Well, they're seeking more opportunities. I mean,
so they're actively seeking more.
Yeah, I mean, if you speak to high net worth and family offices and various investor groups, I mean, they're seeking certain rates of returns, and they're primarily going to get them through alternatives at this point in time. So,
Because why you can't get those expected returns are not available in other asset classes?
Listed market, yeah. I mean, look at bond yields right now, and look at where the equity market is right now. So, obviously the cash rate. So that's driven up, asset prices. I think to this point in time. Yes, we saw a lot of volatility. Let's call it over the last 18 months, not just 12 months, but let's call it 18 months. But it means that investors are looking potentially more for more stable returns. You can get them through alternative asset classes.
That's interesting.
Like credit.
So I've got two questions for you. The first is, in your conversations, what are the rates of return that investors are seeking?
Well, it depends on the nature of the investments that they're deploying capital in. So if you're doing first mortgage, investments, investors are looking at 5.5%, 6%, right up to 10%, even north of that on first mortgage, type investments. Then if you're doing sort of second mortgages as an example, you're starting to talk about, let's call it 15% plus, and that's lent to an asset, so it's all asset backed. And then you've got even the property development assets, you're north of 15, 16 or 20% plus. That's the expectation, from a capital perspective. If you're going, and there's shorter durations, okay, so you've got 12 months to, let's call it 36 months, with their investment duration. Whereas if you're going into private equity, I mean, the expectation is, north of 25%. We invest our own money, into a number of funds that we act as trustee for, private equity funds, are shooting north of 25%. So it really depends on within the alternatives bucket where they're deploying capital. But the expected rates returns are kind of in that sort of broad sort of buckets.
Those returns that you talk about where, you talk 10, 15, 20, especially 20, 25%, clearly there's much higher rates of risk that one takes on. And whether it's liquidity being a risk, or the whole investment thesis failing, that's a risk. Those numbers, are they consistent to what they've been over the last few years? Is it lower than what it's been? Is it higher? Can you just give us insight on that?
I think in the credit space, there has been sort of margin compression or yield compression, but they've sort of stabilised more recently. And I think it's a combination of, yes,
where have they stabilised that?
Also, well, first mortgages, I mean, from an investor's perspective, you're talking, 5.5%, 6%, right up to 10%. So, it's still a healthy margin over the cash rate or the
absolutely
swap rate. But it was normalized to be, talking around 9 to 10% on first mortgages, but they've certainly come in. And I think, as I said, it's a combination of the yield curve, the cash rate coming in, but also the level of competition within credit funds. There's just a massive emergence of credit funds.
Do you think that's a fad, or do you reckon that'll continue?
No, it's sustainable. It's sustainable. I mean, if you look at the Australian market from a non-bank financing perspective, versus say the US or Europe, we've probably got another 4 times where we are now, to go, because in the US, as an example, I think non-bank financing makes up about 80% of the market, which is huge. Same with Europe.
And what do we hear in Australia?
10% at best, at best. Non-bank, yeah, correct. So if you include the 4 majors and say Macquarie, I mean that is the bulk of the market.
Yeah, it's big market share. And maybe it's a thing that Australian investors need to get used to, right? It's this shift in the way things are done, and that'll take time. If you're talking about 4 times the size. But then what about in private equity or VC? I don't know how long fractionalized car investing's been going on. Simon might know a bit more about that than you and I. But you know, if you talk about VC and other funds, that what about that? What are the returns that these types of funds been generating? If we look back 5-10 years ago.
Yeah, I mean, I don't know if the returns are too different today as to what they were 5-10 years, but it's more around just the market acceptance of them. So again, Australia historically was very underrepresented in the VC space. So you generally have to go to the likes of, the US or Israel, et cetera, to actually, see these sort of great sort of startups. And you'd argue that some of the quality of the assets in Australia probably weren't as high as what they are today. So they've really, startups have come a long way, and there's a better ecosystem here. So people are looking for access into them, but I think people are wanting smaller exposures to those VC type companies. So again, through a fund structure, it really gives people that diversification, into the underlying assets themselves. I think we've still got a while to go in terms of the VC space. It's a relatively immature market here, and the government is actually doing things, to actually support that. What they call the ESVCLP regime, which are early stage venture capital limited partnerships. It's just a tax-driven structure that allows investors to generate tax-free sort of returns. So they're really encouraging the investors to come in. There's also the I forget the name of them anyway, but there's a different type of structure that different investors can deploy the capital into these sort of early stage companies. But I think there's still a long way to go. We just simply don't have the sheer scale from a sponsor or an asset company perspective versus say in other parts of the world. It's relatively immature. But Australia's becoming far more well regarded, or becoming more well regarded, if that's the right English. On a global stage perspective, the quality of the startups is just fantastic now. It's really, really good. And I think during COVID and some of the issues that we've seen geopolitically has just really forced more innovation in Australia, and for us to produce more and manufacture more and develop more here in Australia. So I think there'll be an attraction of capital into these early stage sort of companies, which I think is fantastic, to be honest.
I hope you're right, Koby. One thing you said before, investors are looking for more stable returns. Do you think stability and being compensated higher with return kind of marry up? Meaning, if your investment is more stable, would you expect to get paid less or more for that investment? Because I totally hear you. I know people want a bit more stability, but I just wonder, stability and more return, to me, just hand in hand. Doesn't make sense. They're both contradictory if you go back to basic investing. But I could be totally wrong.
Yeah, no. It's a natural question to be asking. It's like, if it's more risk, it should be higher return. That's the thing that goes hand in hand. I'd argue that it just depends on the asset class that you're investing in, and I'll just say that because people are being compensated for lack of liquidity in credit, as an example. So if you're commanding an 8, 9, 10% return on first mortgage, which are contracted cash flows, it is relatively low risk versus, say, a listed equity, right? But you don't have the liquidity. That's where you're getting compensated, because you're foregoing some liquidity to get those higher rates of return.
I hear you. Yeah.
So I think there's a fair compensation in that. And the argument I'd also have here is, people talk about liquidity as if it's an essential need 100% of the time. Now, I've never liquidated all of my assets in one go at a given point in time. And so you're paying away a lot of upside for liquidity that you may not ever use. And sadly, as you know too, when there is a credit crunch, when there is a crisis, when there is a shock to the system, liquidity actually dries up when you need it the most. And so you've actually foregone a lot of your return along the way for the liquidity that you may need to exercise. And when that event does arise, it actually dries up. So there's nothing wrong with having liquid assets, absolutely not. But I'd argue, to what extent, you need liquid assets because you're not really exercising that optionality to redeem, all of your money all at once at a given point in time.
And I think, Koby, that really speaks to the comments you were making before, the questions you were asking about, well, what does a financial advisor actually do? Is it this, or this? One of the things that I think a good advisor can do is help people design a portfolio that aligns with their life and the things that they want to be able to do, whether it's buying a new house or whether it's buying a business or liquidating a business or whatever the case may be, is being able to understand those cash flows, those needs and those wants and those desires, to then marry that up with the balance sheet. And it's almost linking up, people's lives and people's balance sheets rather than looking at them as two independent things. Right?
Yeah, isolated, correct.
And so with that, I think a good advisor can help people build portfolios that do have some liquidity, some illiquidity, and you expect a premium for that illiquidity, but also be able to be really clear. I think investors don't do this enough, is be damn clear on what you're holding and why. Why are we holding this thing? Why do we go in? What's the exit strategy? People, I find that people just typically just accumulate with no real thought or consideration around why are we even doing this? How do we end up with this myriad of or this mosaic of a portfolio that doesn't really make any sense anymore? So I think that's really important. And mate, I totally agree with you. I think this is an evolution. I think that there's a long time to run for this to continue, for this to be fully evolved. Are there going to be collapses and disasters and tears? 100% there will be. I think it's just with anything. But it goes back to designing portfolios and investments that you understand and the risk is managed at a portfolio level, because certain individuals 100% will fail. If you look at how many companies underperform indexes for that matter, or how many companies collapse over a certain period of time, how many companies fall out of indexes, a lot of people will be surprised at some of those numbers. Koby Jones, I haven't seen you in real life for so long, man, but this goes some way in making me happy. So, awesome. I think we're opening up soon. I'll be double jabbed, I think, shortly. So we'll 100% grab a beer at before Chrissy. Mate, good to see you. Thank you so much for your insight, and I look forward to hearing how business goes for you guys, because you guys are smashing it. Well done, man.
Yeah, look, Rob, thanks very much. And I just want to congratulate you as well on the initiative that you're undertaking here in Masters in Investing, and also your overall success. I think you are changing the landscape and just really having conversations that need to be had, I think, just generally in the industry, and, challenging sort of the status quo. So hats off to you, buddy.
Thanks, man. Appreciate it.
Really proud of you, mate. Yeah, really proud of you. So great to have just a casual conversation, mate. So, but yeah, thanks for your support as well.
Thanks, Kevin.